Hello everyone, and welcome to Financial Accounting. In today's video, I'm going to go over Chapter 3, which is about the adjusting process. The reason we have this chapter is because in accounting we have two concepts. One of those concepts is something we call it the cash basis, and the other concept is the accrual basis. Maybe I call them concept, but they're basically two ways of doing accounting. For large companies in the United States, and I think in most countries in the world, the accrual basis is the acceptable and required method in order to present your financial statements. So we'll start by talking about the cash basis versus the accrual basis, and then we're going to see what are the adjustments we need because we are using the accrual basis. So as it says here, under the accrual basis of accounting, revenues are reported on the income statement in the period in which a service has been performed or a product has been delivered. And that's the main idea about the accrual basis. It doesn't matter whether we got the cash or not. What matters is that we provided the service or we delivered a product to the customer. So once we provide the service or we deliver a product to the customer, we earn the revenue. What if the customer didn't pay us cash yet? It's still a revenue. And this expected cash to be collected would be recorded as accounts receivable. In a cash basis, it doesn't work that way. In a cash basis, the revenue is only recorded when we actually receive the cash. So that's the major difference between the accrual basis and the cash basis. So again, under the accrual basis, cash may or may not be received from customers during this period. The accrual basis of accounting also requires expenses to be recorded when they are incurred, not necessarily when cash is paid. So again, we isolate ourselves from the cash payment. That's not the measure of how we earn revenue or we incur expenses. What really matters is whether we provided a service, whether we received the service, whether we provided a product, whether we received the product or not. So GAAP, which is the generally accepted accounting principles, require the accrual basis of accounting. So we have to use the accrual basis of accounting if we are to follow GAAP. On the other side, if we look at the cash basis, under the cash basis of accounting, revenues or expenses are reported on the income statement in the period in which cash is received or paid. So in other words here, our income or our revenue, if I can call it, is actually tied to the cash received. If I receive the cash, then I have a revenue, I have an income. If I haven't received the cash, then there's no income, even if I provided the service or the product to the customer. And of course, this is not acceptable again. The IRS would accept it if you're using it for your own like accounting system, which is not an official accounting system. But if you want to present the financial statements to the public, then you have to follow GAAP. So as it says here, most individuals and small service businesses may use the cash basis of accounting. For most large businesses, however, the cash basis would not provide accurate financial statements for user needs. And this is why we have to follow GAAP, which is the accrual basis of accounting. So under the revenue recognition principle, revenues are reported when services have been performed or products have been delivered to customers. And the revenue recognition principle, that's one of the important principles, and I think we talked about that in Chapter 1. But I want to remember that because of the accrual basis, now we have to worry about the revenue recognition principle. So revenue is normally measured as the assets received, such as cash or accounts receivable. The process of recognizing revenue is called revenue recognition. So whether we got the cash or we got a promise to get the cash, which is what we call it accounts receivable, that's how we measure the revenue. And we recognize the revenue once we provide the service or deliver the product. Let's look at the other side of the coin, which is the expense recognition principle. So under the expense recognition principle, the expenses incurred in generating revenue must be reported in the same period as the related revenue. This is sometimes referred to as the matching principle because we match revenues with the expenses for the same period. So by matching revenues and expenses, net income or losses for the period is properly reported on the income statement. Adjusting entries are required to properly match revenue and expenses. So now let's talk about the adjusting process, which is the main focus of this chapter. And we'll see 4 different types of adjustments plus one, which is, I think it's easy, which we refer to as the depreciation. I think it's a standardized kind of adjustment. The other four, we have to understand them because we can get or mix between them. So we want to make sure that we understand which one applies to which scenario. But for depreciation, which is the last kind of adjustment, I think it's straightforward, very easy, and we're going to talk about it in a future chapter when we go over fixed assets. So at the end of an accounting period, an unadjusted trial balance is prepared to verify that the total debit balances equal the total credit balance. And I hope you remember that when we had the unadjusted trial balance. So many of these account balances are reported in the financial statement without change. So some accounts on the unadjusted trial balance, however, require adjustments for the following reasons. So we have like few reasons that invite us to make these kind of adjustments. Some expenses are not recorded daily. Some revenues and expenses are incurred as time passes rather than as separate transactions. And also some revenues and expenses may be unrecorded at the end of the accounting period. So let's see some examples for each one of these. And let's start with the first one. Some expenses are not recorded daily. For example, the daily use of supplies would require many entries with small amounts. So we typically buy supplies and record them as assets, and then at the end of the month, we just do some kind of fiscal count to see how much supplies we used, and that would be recorded as an adjusting entry. So we need adjustment to see how much of the supplies were actually used, and that's an adjustment. Another example for some revenues and expenses are incurred as time passes rather than a separate transaction would be an example for rent. For example, rent received in advance, which we call it unearned rent, it's a liability, expires and becomes revenue with the passage of time. So once time starts passing, we earn this revenue. But when the tenant pays us in advance, and we are here the landlord, when the tenants pay us in advance, that's a liability. We haven't earned it yet. So by the time, when the time passes, we have to earn this revenue, and we record it as a revenue, and we need an adjusting entry for that. Another example for some revenues and expenses may be unrecorded at the end of the accounting period. For example, a company may have provided service to customers that it hasn't billed or recorded at the end of the accounting period, and now it's a time to send them an invoice and ask them to pay us the money. So we need an adjusting entry for that. So the analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. So this kind of procedure that we go through is called the adjusting process. The journal entry that brings the accounts up to date at the end of the accounting period are called adjusting entries. So we have the adjustment process and we have adjusting entries. Remember the journal entries? It's very similar to journal entries, but we just call them adjusting entries. One main characteristic about adjusting entries is that they're always at the end of the period. So let's say we have a fiscal year that ends on December 31st of this year, 2020. Then the adjusting entry would be dated December 31st, 2020. So usually they are at the end of the year or the accounting cycle, whatever the accounting cycle ends, or whenever the accounting cycle ends. The other thing is adjusting entries. You'll notice that, as usual, like journal entries, they include two accounts affected. But in this case, for adjusting entries, one of these accounts would be an income statement account and one would be a balance sheet account. To be more specific, it has to be an asset or a liability. So by an income statement account, we mean here that it's going to be a revenue and expense. And by a balance sheet account, it could be an asset or a liability. One third condition that you'll also notice that adjusting entries never involve cash. So you'll never see the account cash in any adjusting entries. So whenever I see you preparing an adjusting entry, I'm not expecting to see the account cash because cash is based on a real exchange. But adjusting entries, they're not based on real exchange because there's no cash received or cash paid. So again, to reinforce that, all adjusting entries affect at least one income statement account and one balance sheet account. And I want to remember that. Also, an adjusting entry will always involve a revenue and expense account and an asset or a liability account. So what are the types of accounts requiring adjustments? there are two general classifications of accounts requiring adjustments, and these are accruals and deferrals. I want you to remember the word accrual as unpaid, and deferral is prepaid. So when we have something that the service or the product is delivered before the payment, we call that an accrual. If we have something where the payment was ahead of the service or the product, we call that a deferral. So I always try to translate it in this easy way. Accruals, these are unpaid. Deferrals, these are prepaid. So let's start with accruals. An accrual occurs when revenue has been earned, when expense has been incurred, but has not been recorded. So if the accrual is for revenue, the adjusting entry debits the assets, which is in our case would be accounts receivable, and credits a revenue account. So we earn the revenue, but we haven't received the cash yet, and that's why we record the accounts receivable. If the accrual is for an expense, the adjusting entry debits an expense account and credits a related liability account such as accounts payable or wages payable. And try to remember that. Revenues, they like to be recorded on the credit side, and that's why in the adjusting entry we credited the revenue account. When we have a case for an expense, you remember that expense is on the debit side. They like the debit side, and that's why we debited the expense account and we credited the accounts payable or wage payable or whatever kind of liability that we have to record. So let's see an example here for like a table that summarizes how the accrued revenues and accrued expenses would be recorded. So we have here adjustment data, revenue has been earned, and a journal entry hasn't been made. So the adjusting entry would be accounts receivable on the debit side and revenue on the credit side. If we have an accrued expense, which means unpaid expense, so we have here an expense has been incurred, however, no journal entry has been made yet, so we need to make the adjusting entry. So we debit the expense and we credit the accounts payable. Remember, one is a balance sheet account, which is the accounts receivable, and the other is an income statement account, which is the revenue. Same thing, expense, we have income statement account, and then we have a liability, which is a balance sheet account. And you see, never involved cash. So cash was never part of this journal entry or adjusting entry. So now let's see the other side, which is deferrals. A deferral, as I said, it translates in my world to prepaid. Okay, when they have the cash ahead of the service or the product. So deferral occurs when a cash related to a future revenue or expense have been initially recorded as a liability or an asset. So if the cash received is related to future revenue, it is initially recorded as a liability and it's called unearned revenue. And remember, I told you that we have the word revenue, but it's not really a revenue because it's unearned. So if we ever see unearned revenue, you should always remember that's a liability. And this happens when a client or a customer pays me for a service before I provide them with a service. And this happens in many cases. Like always remember when you pay your your cell phone service ahead of time, like you have the prepaid cell phone. So if a prepaid cell phone, from the company's perspective, that's unearned revenue until you start making the calls. So the adjusting entry in the period when the revenue is earned debits and unearned revenue counts and credit the revenue account. And we'll see that in the next table. If the cash paid is related to a future expense, it's initially recorded as an asset called prepaid expense. So sometimes we buy supplies or we buy an insurance policy in advance and we haven't received the service yet. So we call that prepaid expense. It's recorded as an asset, even though it has the word expense, but it's not an expense because it's prepaid. Once it's used, it gets to be an expense. So the adjusting entry in the prepaid or in the period when the expense is incurred debits an expense account and credits prepaid expense, which is an asset in this case. So like we did with accruals, let's see this table for deferrals. We have here an example for cash has been received for revenue, will be earned in a future period. So what happened is that when we received the cash, we debited cash and we recorded the unearned revenue. Now the revenue has been provided, so we need to record this adjusting entry. We debit unearned revenue, which is the liability, and then we credit the revenue. And that's the adjustment that we need to do once we provide the service to the customer. What if we are the one who are receiving the service? So it's an expense. We paid in advance. So cash has been paid for a future expense. So at the time we pay the cash, that's a real transaction. It's not an adjusting entry. So we debit prepaid expense and then we credit cash. And then later on, we need to make an adjustment because we've used this kind of prepaid expense. So prepaid expense has been used to generate revenue. So in this case, we debit the expense, let's say supplies expense, insurance expense, whatever kind of expense we incurred, and then we reduce this asset on the credit side by recording the prepaid expense on the credit side. So that's how we make the adjusting entry. Notice, here we had cash because that was a real transaction. But for the adjusting entries, we never have any kind of cash involved. And again, one is an income statement account and the other is a balance sheet account. So remember in chapter 2, at the end of chapter 2, this is where we stopped, where we had an adjusted trial balance. And it's just a trial balance where we try that the debit and credit match. So in this case, we had this kind of accounts that we've seen all the way, or starting from cash accounts, receivable, supplies, all the way to miscellaneous expense. And we usually have these two debit and credit balances matching. So in today's chapter, we're going to see some new accounts added to the chart of accounts. And these accounts include accumulated depreciation for office equipment. We have wages payable, rent revenue, insurance expense, depreciation expense. These are new names that we're going to see in today's chapter. So I stop at this point, and in the next video I'm going to start going over the adjusting entries or how we record accruals and the deferrals using some examples. Thank you for listening.